Okay, hello. Welcome to the second video of 2 for Chapter 11. We're going to finish up with the variances. And this should be a fairly short video, or at least shorter than the last one, because we won't have to do as much explanation. It's going to be a little bit of a repeat of what we did before in the first video, just with a couple of different names for things, but the process is almost all the same. So let's take a look here. Okay, so we're going to look at direct labor, and then we're going to split out variable and fixed overhead. So we did direct materials last time, and we'll talk about that here in just a second. So we're going to do direct labor, and then we're going to do direct labor and variable overhead are very similar to the direct materials. And then fixed overhead variances, well, that's a little different, but it's actually a little simpler. So these last couple are going to be kind of it's important to split them out just so that you don't get confused with the terminology, but it's the same process, and I think I have found in the past that the kind of going it over a couple of times, the reinforcement is helpful. I found it to be helpful for students. So let's just kind of remind ourselves, so this is direct labor variances, but this picture that we have here at the top is actually the direct material variance. And just to remind you, on this side over here, let me see. On this side over here, we've got the actuals, right? And over here, we've got the budget with the standard cost. And if you remember this in between, you don't have to call it this, but I kind of call it the should be. In other words, what should be the cost if we use the standard price with the actual quantity? And then we have down here, we've got these two items. And we've got a direct materials variance and a direct materials price variance and a direct materials quantity variance. And remember, the easy way to remember this is whenever you have a quantity variance, well, you've got to take the difference in the quantity. So you have to take the actual minus the standard. And the price variance is taking the difference in the price, the actual minus the standard. You do have to kind of get in your head here that you have the actual quantity and the standard price as the multiplier on these two sides, but that's probably the extent of it. So not should be. Okay, so what is the difference with labor variance? Almost nothing. The only thing that is different is the terms. So up here you see it's standard quantity times standard price. Down here we're going to use standard, well, let's see, maybe this is a little easier. Looking at these versus these. So instead of actual quantity, we have actual hours. Well, hours is a quantity, and price, down here we've got rate. So all we're doing is substituting the word quantity, hours for quantity. In other words, quantity is more generic, right? Quantity of units or whatever. Here we've got a specific quantity. We have hours, number of hours. So quantity is, for the direct materials, is a number of something. Here, down for labor, we almost always go by number of hours, and so on and so forth. The price and the rate. Well, okay, so hours is going to be a number, rate is going to be some sort of dollar, and we're going to continue to remember that anytime when we talk about the quantity, and in this case the hours, the quantity or the hours, we're going to be focused on total quantity, total hours. Anytime we talk about price or rate, we're going to be looking at, units. What is the per hour rate? But otherwise, it's calculated just the same. When we have okay, so I guess one more terminology. So this is the rate variance. And instead of saying this is the hour variance, for whatever reason, they're going to use the word, instead of saying direct labor hour variance, they're going to say the efficiency variance. Okay, that in times past, there probably was a reason in managerial accounting that we called this efficiency because it had a certain meaning. But just remember that the rate variance is the price variance and the efficiency is the quantity variance or the hour variance. So other than that, everything else is kind of calculated the same. So let's take a look at a problem here. So this is going to be similar to question number 4, and we're going to do the same thing. I'm going to kind of suggest, in order to make sure that you get everything right, that you look at you look at these items and kind of map them out in your head or down on paper before you go forward. So instead of a product, we have a service. So the service in question is an oil change. Now the particular labor, so there could be processes that have, so in the previous one we had there could be a lot of different direct materials. But similar with this, in a service, there could be different types of direct labor. It could be the guy that puts on the tires. It could be the guy that does the actual oil change or whatever it is. So there could be a different direct labor, I guess, services. Here, well, almost always it's going to be wages per hour or dollars per hour. So when we look at the actual hours, so if you remember in the last one, 2 of them were given and 2 we had to calculate. Actually, when we go through here, the standard wage rate is $10 per hour. Okay. So that's the standard rate, $10. By analyzing this past record of time spent, it has developed a standard of 12 minutes or 0.2 hours. Okay, so we'll just kind of leave that alone for right now. In July, 1,400 oil changes took place. Okay, we're going to use those 2 in just a moment. Oil change technicians worked a total of 265 direct labor hours. Okay, so this, remember, this is the total hours. They're giving it to us directly here. And at an average rate of $16. So remember, they don't say actual, but these are actuals here. These aren't our budgets. So $16 is our, and if you notice, this one, and this one are given. And as I mentioned before, typically the standard quantity or the standard hours is the one that's a little difficult to, I don't want to say figure out, but it's the one that it takes a little bit more conceptual idea of what's going on. So what we're thinking about is, remember, we kind of think of this as kind of the flexible budget idea. If we had budgeted 1,400, if we had budgeted 1,400 oil changes, and we knew our standard rate was 0.2 hours, then we would have budgeted how many hours? We would have budgeted a standard hours of 280. But that's the only one that we have to calculate. So let's go ahead and throw it in here. And note again here that it's not price variance, it's rate variance. It's not quantity or hour variance, it's efficiency variance. But otherwise, the terms kind of map out the same. So we have 265 times the actual rate of 16 minus 10. Okay, and even before I calculate it, the actual rate was much higher than the standard rate, right? We actually paid much more than we budgeted. So whatever we figure out here, we already know this is going to be unfavorable. And it actually comes out to 1590. Because remember, when we say, when we consider costs, if the actual costs are higher than the budget, that's unfavorable. If we're looking at a different variance, if the actual income is higher than the budget, well, that's favorable. So just remember, it's context related. Down here, the standard rate is 10. The actual hours was 265. Our budgeted hours, our standard hours allowed, is 280. So we actually worked, even though we paid them more, we worked less than the budget. So this is going to be favorable. Now you would combine those two to kind of come up with a total labor variance, but this is 150. So if you notice, even though we worked fewer hours, the effect was rather small. This is like 1/10 the size of paying them too much. So in other words, you know, if your employee comes and says, oh, we worked a lot less hours, and don't look at this rate variance. Well, the reason why is because the rate variance, we paid them a whole lot more, and that overwhelmed the little positive that we had from the working fewer than the budgeted hours. Okay, so the next one, so that was direct labor. We're going to look at the flexible manufacturing overhead. And if you remember, we always look at costs and the direct materials, direct labor, and then we break out variable MOH and fixed MOH. So this is our variable MOH. So if we look at this, we've got company produced tables. Okay, so this is the service or the product. The standard variable manufacturing overhead rate was, okay, so again, we're going to be using hours here as the quantity and rate here as the price. So the standard rate, and remember, keep in mind totals for the quantity and units for the price, or total for the hours and units for the rate, is $16 per machine hour. I guess we should say here, the standard rate used by company is $16 per machine hour. So the unit here is machine hour. And they give us $16 here. $16, so this is given. Each table requires 3 machine hours. Okay, we'll come back to this. Actual machine hours were 1330. Okay, so that's one of our items, 1330. So we'll use that. So we've used this one and we've used this one. And the actual variable MOH rate was 1650. So the actual rate was 1650. So once again, 3 of the 4 are given. And once again, it's the standard quantity or the standard hours. That's the one that they typically like to make you figure out because it requires you to think about things. So remember, we think about this in a flexible budget manner. In other words, if we budgeted 4,500 tables, if that's how many we budgeted, and we knew that, so that's this number, and if we knew that each table required 3 machine hours, our standard hours allowed, the budgeted hours would have been 1,350. So this is the only one we had to calculate, and we just had to make sure that we picked the right numbers. Once again, when we throw this into the equation, we've got 1330 hours as their actual hours. The actual rate was 1650, and the standard rate was $16. So if you notice, the actual rate was higher than the budget. So what we actually paid is higher. So we already know. Oops, look again. I forgot to to delete that. I thought I had deleted that. Okay, and actually this ends up being 0.5 times 1330, which ends up being 665. The standard rate is $16, and the actual hours is 1330, and our budgeted calculated hours 1350. Oh, look, I forgot to get rid of both of these. So our actual hours worked and their standards, sort of like the last one, we worked fewer hours, but we paid them more. Except what we paid them was not quite as egregious. It wasn't quite as much. So here, the 320 is favorable because we worked less than what we would have budgeted. Now, when you combine these two, it's still going to be unfavorable. It's going to be unfavorable to the tune of 345. So you might look at this and say, if they just gave you the combined variable manufacturing overhead variance, you said 345 unfavorable. Oh, that's pretty close. We don't really need to investigate. But by breaking this out, and that's the whole purpose of doing this, is by breaking it out into quantity and price, or hours and rate, that we can actually learn a little bit more about what's going on, because the whole idea of managerial accounting, once again, is to give managers enough information to make decisions to do something about improving the business. So you could see here that even that 15-cent rate paying over was enough to make the whole thing unfavorable. Okay. The last thing that we look at is going to be the fixed manufacturing overhead. And we go about this slightly different way. So we've got an easier equation, and it's just two. We've got a budget variance and a volume variance. And we'll take a look at that here in just a moment. So once again, maybe not as useful for the fixed, but we're looking at doghouses here. Produces luxury doghouses. Well, okay, that's good to know. Each doghouse requires 3 hours of machining. Okay, we'll use that here in a second for its elaborate trim and finishing. For the current year, the company calculated its predetermined, oh yeah, remember that word, predetermined fixed overhead, fixed manufacturing overhead at $23 an hour. Okay, so we don't need that quite yet. We'll come back to that. The company budgets its fixed manufacturing overhead at $74,000. Okay, so the budgeted FMOH, $74,000. Okay, so we're using that. Last month, the company produced 1,000 doghouses, okay, and incurred $76,000 of actual fixed MOH. Okay. Well, the actual and the budget, well, we can look at what's the difference in this. And if, in fact, that's the first thing. That's the budget variance. So the actual minus the budget is 2,000. And once again, the actual was more than the budget, so that's an unfavorable. Now, how do we get the standard FMOH cost allocated to produce? Well, that's similar to how we looked at before. Once again, this standard allocation is based upon kind of a flexible idea. So if we were to budget this, if we were to allocate this cost, we would say 3 hours. Each doghouse requires 3 hours, and we produced 1,000 doghouses. So 3 times 1,000 equals 3,000 hours. And what is the rate? The rate is 23. So times 23, and that would equal 69,000. So when we go down here, the budgeted MOH, well, once again, we just pull this down. The standard allocation, what we would have allocated, given that certain production. And the variance here is 5,000. And which way does this go? We would have allocated, based upon the number of houses, we would have allocated 69,000. And we actually budgeted more, so we have an unfavorable volume variance. Okay, so this one's a little more streamlined, a little simpler, but I think the thing that throws people off a little bit is that they kind of use the budgeted versus the standard costs allocated. You haven't seen that kind of arrangement, so just be aware of which one goes first, and it still comes out the kind of the same sort of easy calculation. Okay, well, as I mentioned, this one's a little simpler and a little more straightforward. If you have any questions, make sure you hit me up on email or catch me on Zoom. Don't be afraid to email me if you'd like to talk about any of the quizzes or whatnot. I'll be happy to walk you through anything. I should be putting out a exam prep guide, and I'll send out an email to you in the next tomorrow. Okay, thank you.